Welcome to this half-Q session. We are starting our debut series titled You and Your Bank Account. As a holder or a potential holder of a bank account, this series of videos is useful to watch. The videos are easy to follow no matter your background. The focus today is on 1 out of 10 things you should know about your bank account. Before we begin, do you know there are conditions you must meet for a bank to process your transactions? Stick around and you'll find out what they are. Also, we have added timestamps in the description for ease of navigation, and references will be provided at the end of each video. As this video is our first in series, let's take a little preamble. Now, there are 7 different regulatory categories of financial institutions in Nigeria. We have deposit money banks, we have bureau de change, we have discount houses, development finance institutions, primary mortgage institutions, finance companies, and microfinance institutions. We say regulatory categories because it is the way the Central Bank of Nigeria categorizes them for administrative purposes. Our interest, however, is on deposit money banks, and they are mostly called commercial banks. There are 23 licensed commercial banks in Nigeria as of June 2021, and the number of adults with bank accounts in Nigeria was estimated at 47 million in 2020. Most of these accounts are held with commercial banks. So, what do these banks do? The answer is simple: financial intermediation. Banks do not keep all the money they receive from customers only to wait for such a time when customers will come and withdraw their money. When a customer deposits money with the bank, banks do business with the money by simply lending it out. That way, they move money from those who can afford to keep it to those who urgently need it. In other words, surplus to deficit. That's financial intermediation. The best way to keep track of money movements is by keeping distinct record of every transaction in a specific account. That way, there is no confusion as to who is due what at any point in time, and it is easier for the government through regulatory agencies like CBN, NDIC, etc. to monitor these banks. This makes account opening a necessary condition for any banking relationship. The relationship between a bank and a customer starts with opening an account. Every bank must create at least one distinct account for each of its customers. It can be more though, but let's not get into that yet. In any case, there are rights and limits that both the bank and the customer have on these accounts, and your financial education and planning starts with being aware of what these rights and limitations are. What more, these rights and limitations are contained in a contract. Okay, in legal parlance, a contract is merely an agreement between parties to do or not to do certain things for whatever consideration. It may be too technical to go through the entire scope of contracts, but for the purpose of this video, the first thing you should know is that there is a contract on your account. The moment you sign an account opening package and an account is opened for you, you have made a contract with the bank. The bank must keep confidential safe custody of your money. Well, this is not the extent of your contract with the bank. However, for this video, let's leave it this simple. Anyway, contracts should not be strange, since the society cannot function without contracts, and you are not new to it either. We all make contracts every day, but since this video is not about contracts, we will not go into the elaborate nature of contracts. Just know that these contracts can be oral or written depending majorly on 4 factors. The factors are the tasks to be performed, the amounts involved, the expectations of the parties, and the dispute resolution mechanism the parties may choose to adopt. Now, these factors may not cover the entire scope of contracts, but it gives a proper perspective as to why some contracts are oral and why some have to, as of necessity, be written. Oral contracts are more common in the society, like boarding a bus, buying groceries, hiring a plumber. The list can be endless. The thing is, oral contracts are mostly convenient. You do this and I pay that. The tasks are simpler to perform, the amount of values are smaller, the expectations are easier to manage, and any argument is relatively quicker to resolve. Most often, you do not see the need to write it down because of these factors, not that you can't. Any contract can be written down if you wish. However, some species of contracts just have to be written down in ink. For example, buying land, leasing an apartment, buying a car on hire purchase, borrowing money, or using applications and licenses on your phones or computers. When a contract is required to be written down in ink, it is not necessary that it must be on paper. Sometimes it could be as simple as clicking a button, accepting the terms and conditions on a site before using a license or an application. It becomes necessary to write contracts down where the tasks are more complex, where the values are higher or the payment may not be as simple, where the expectations are harder to manage, and where the disputes may require formal intervention of a third party to resolve. Take buying a house for instance. It is complex for two reasons. First of all, there are a series of tasks to perform, like visiting the site, conducting surveys, verifying the title documents, signing and registering ownership or transfer documents, and so on. Secondly, such a contract is complex because of the wide extent of engagement. You have to involve the land registry, surveyors, solicitors, agents, and maybe even include certain members of the community. Next, we could also see that for buying a house, the value is usually a large sum and sometimes the payment may not be as instant. The parties may agree on a later time, mode, or manner of payment. It could be deferred, say a part payment now and the balance to be paid later, or staggered, say regular payments at certain intervals, whether monthly, biannually, annually. It could even require a payment method or a process to complete, for instance, raising drafts or paying a neutral third party who would remit the money to the seller when the deal is done. Then again, the expectations when buying a house could be hard to manage in terms of quality, place, and time. The parties may agree on the who, how, and when regarding conditions for possession, eviction of previous occupants, making fixtures or reinstatements, completing works to be undertaken before or after the transfer of ownership, or clarification on restrictive covenants. Whichever be the case, it will be difficult to manage these expectations if the contract is not written down. Finally, a dispute resolution mechanism needs to be negotiated. The parties may have to agree on whether to use a nominated mediator, arbitrator, or even the court. What you need to know is that writing the contract down helps to specify these terms and conditions, and it also helps to provide a reference document of what was agreed, sort of like an evidence when the need arises. After all, the faintest ink is sharper than the sharpest memory. Similarly, banking contracts fall within the category of written contracts. Whether for a current or a savings account, by mere signing an account opening package along with the necessary documentation, you have consented to the terms of a demand deposit account. Let's call this contract a basic banking contract. Don't get me wrong, banking contracts can get more complex than just a basic contract, especially where the customer is considering expanding the nature of its relationship with the bank and subscribing to a wide variety of other products and services banks have to offer customers, like term or fixed deposits, loans, investments, and the likes. Anyway, with a basic banking contract, you have a demand deposit account. These are accounts that allow you to give money to the bank and carry out basic transactions, deposits, and withdrawals on your account. This can be done at will but subject to certain conditions. We will look at 4 major conditions, but you must know these are not the only conditions that can be tied to a transaction on your account. The first condition is complete KYC. Know Your Customer is a verification conducted on the details of the holder of a new or an existing but dormant account. When an account is opened, this condition is imposed on the account such that you cannot make a debit transaction on it, be it a withdrawal or an outbound transfer, unless due diligence is completed. In other words, money can't leave. The bank must carry out this due diligence by verifying information and documents submitted for account opening. This condition is forced on accounts by the Central Bank of Nigeria in order to check against money laundering and terrorist financing activities. To this end, CBN has profiled all customers' accounts in terms of value. We have Tier 1 accounts. These are strictly savings accounts that have low limits on what they can hold and require little or no verification on customers' details. Verification here is merely desirable. Then again, we have the Tier 2 accounts. These are also strictly savings accounts with higher limits on what they can hold and require verification on the customer's identity. Other verifications are desirable, not necessary. However, we have the Tier 3 accounts. These are the standard current savings or domiciliary accounts with full verification required, and sometimes the customer in question may have to submit even references for a current or a dorm account. Whatever the account category, this verification has to be dealt with before a customer can exercise his or her right to make withdrawals on the account. So let's move on to the second condition. The second condition is regular mandate. That is the signature or authorization on request. Every customer gives instruction to its bank through a source document. Source documents could be electronic. It is evidence in ink that a request has been made to the bank. These documents have to be signed or authorized by a customer to the satisfaction of the bank before the bank can act on it. failure to do so gives the bank the right not to honor the request. This condition is more of a safety requirement to remove deniability from transactions. This way, customers cannot come back later to disclaim a transaction and say, "I didn't authorize this," or "that is not my signature." Banks are particular about this deniability because under the Cybercrimes Act, it is the duty of the bank to adopt counter-fraud measures and justify any unauthorized debit on a customer's account. Otherwise, they have to reverse that debit within 72 hours of making the complaint, and the bank will bear the loss. This means that banks have to be extra careful to be sure the instruction came from the authorized signatory to the account. Moving on. The third condition is available funds. The basic banking contract is an agreement to receive and pay the customer money when the customer is transacting on his or her account. Transactions on an account entail two things: an entry or an exit of money, debit or credit. Each activity is recorded as a separate transaction in the account statement, and until such an entry has been made, the presumption is that the transaction has not been consummated. You cannot exercise your right to transact on an account without money. Money in this sense must not always be physical, but it must be in the currency of the account's denomination. Near cash equivalents can also satisfy this condition. Nothing stops the conversion of other currencies into the currency of the account's denomination before consummating a transaction. Likewise, checks, bank drafts, dividend warrants can also be applied to satisfy this condition. Some of these are negotiable instruments, but let's be careful not to generalize them as negotiable instruments, since not all negotiable instruments are eligible for lodgement. The subject of negotiable instruments, just like contracts, is also painfully broad. Maybe if you're interested in another video on either negotiable instruments or contracts, please let us know in the comments box below. There is a point to note here that even where an account is funded, banks have to consider any impediment that can limit or restrict a transaction on an account. For instance, if the account is frozen, if the account is dormant, if the account is overdrawn, if there are currency restrictions, or if there are other claims on the money that can hinder the consummation of a transaction. Whatever be the case, funds have to be available before a transaction can be consummated. The fourth point is business hours. By default, banks are not obliged to attend to transactions on an account outside business hours unless there is an express representation to do so. Business hours in Nigeria is considered as 8 a.m. to 4 p.m. on a working day other than a public holiday, excluding weekends of course. However, the advent of automation has made it easier for banks to uphold their obligation to receive money from or pay money to customers outside business hours. In the lifetime of your banking relationship, you can transact on your account subject to additional terms and conditions by use of debit cards, transaction tokens, internet banking platforms, electronic payment terminals, mobile applications, unstructured supplementary service data platforms, or what we call USSD. Those are the *1, 2, whatever short codes, and so on. This is where other embellishment contracts come in. For all these e-banking options to be available, the customer must have signed the corresponding forms with additional terms and conditions or consented to these products at account opening. These terms and conditions take some but not all responsibilities off the bank. For instance, you have to find a paying ATM on your own. You have to bear network, data or airtime costs for your e-transactions. It is your duty to protect your credentials and tokens from compromise. And most importantly, you are responsible for errors made while inputting particulars for transfers. Just know that it will be difficult to successfully sue a bank for breach of contract merely because the ATM is out of cash or a platform is down at a time when you needed to use it. However, it is still the duty of the bank to ensure the safety and integrity of these platforms. Yes, safety and integrity to process your electronic instructions when initiated using any of these several platforms. Well then, these 4 conditions must have been fulfilled before transacting on your demand deposit account, that is your simple current or savings account. We are not saying that they are the only conditions attached to a transaction on your account, but they are the bare minimum. When dealing with several other types of accounts, other more complex agreements can be added to the basic contract. Those complex contracts may allow the bank to deal with a customer's account for a wide variety of reasons, We shall consider as much of these as possible in the course of this series. Just to recap what was shared in this video, remember that there is at least one banking contract on your bank account. Also, basic banking contracts are usually written contracts that allow you to transact at will on your demand deposit account. The bank's duty is to process your transactions if conditions are met, such as we have discussed in this video. Furthermore, banks' digital products come with additional terms and conditions. And finally, banking contracts become more complex where a customer subscribes to other products like loans, investments, etc. So, try and make it a habit to always read the fine print before you sign the package. Thank you for watching, and as promised, here are some references for your further reading. The links to some of them are in the description along with the timestamps. We will consider the second thing you must know about your bank account in the next video. If there are any other subjects in this video that you need further clarification on, please let us know in the comments box below. See you in the next video.